Hey, what's going on, everyone? Welcome back to the channel all about real estate. My name is Lewis, and in today's video, we are going to talk about debt, specifically 30-year fixed rate debt for a home loan, otherwise known as a mortgage. And I think a lot of people view mortgages as a liability, but I'm going to show you a few different things here that might maybe create a little bit of a paradigm shift so that you look at mortgage debt through a slightly different lens. In many ways, with interest rates as low as they are today, it can actually be a bit of an asset for you. So I'm gonna walk you through a few different items to where I think debt can actually be a powerful tool when used properly. If you are new to the channel and you like all things finance, real estate, and investing, please consider hitting that like button, that thumbs up, and hitting that subscribe button below. Let's go. Okay, so we are going to go ahead and jump right into it. First thing we're going to talk about is where the 30-year fixed mortgage rates are today. So up on the screen, I have a chart of the 30-year fixed mortgage rates, the average in the United States. This is a chart from the St. Louis Fed, and it dates back to about 1970. You can see rates were substantially higher in the 80s, and we've been in a long-term downtrend with interest rates for decades now. But what I wanted to point out is today, the average 30-year fixed rate is sitting at about 3.1%. The reason I want to mention this is because the government is currently reporting inflation numbers like the CPI, Consumer Price Index, at about 6.8%. And the reason why this is important is because for the first time in a long time is that the reported inflation rate is over what the 30-year fixed rate mortgage debt is currently. Prior years, we've seen 1.5% to 2.5% inflation, where interest rates on a 30-year fix were substantially higher. Well, now that has flip-flopped. So we're seeing a lot of inflation, yet we're seeing interest rates really low. And the reason why that's important is because if that trend with inflation continues in the future, it's basically a transfer of wealth from the bank, whoever holds your mortgage, to you. If you are locking in 30-year fixed rate debt at, let's say, 3.1%, and then inflation is running at, let's say, 6%, there's about a 3% delta there. And that difference is essentially a transfer of wealth. It's a way to short the dollar. You're essentially placing a bet that you think that, home prices or the cost of goods and services or wages will increase in the future, which means if it does, and you have a fixed rate mortgage, you're going to be paying back that mortgage with cheaper and cheaper dollars in the future. Next thing I want to talk about is the debt pay down on a 30-year fixed. And for that, I went ahead and I pulled up an amortization schedule, and we're just going to go through a little exercise here. So I'll go ahead and link to this amortization calculator in the show notes below, but I want to walk you through what this looks like. So I'm going to choose loan type, a refi. And let's say the property today, let's say we're looking at a median home price in California at, let's say, $650,000. It's just an estimate. And let's say you have a mortgage of, just call it $500,000. Now I realize this doesn't apply for all markets, but you can use this calculator and do it with any loan amount that you choose. We'll put the cash out entry as 0, and let's put the average 30-year fixed mortgage rate at 3.1%. And we'll do a 30-year term. And let's go ahead and start this in January of 2022. So the mortgage would effectively start next month. That'll make it really easy to see what the debt pay down looks like year over year. So you would go ahead and hit calculate. And then you would scroll. So a couple little things to point out. It says your new monthly payment would be $21.35. That is principal and interest. It does not include your taxes and insurance. Then if you go ahead and scroll down past all of these little, mortgage ads here, somewhere down here, there we go. Then you'll actually get access to the amortization schedule. So a couple things that I really think are powerful here that not a lot of people pay attention to right out of the gate. So first thing I want to point out is on month 1, I want you to take a look at how much you're paying in interest versus how much you're paying in principal. So in interest, you're paying about $1,300. And starting month 1, you're paying $843 towards your principal balance. That's just month one. And what happens is over time, as you make those monthly payments, your principal balance goes down, which means you pay less in interest and more in principal over time. So, a couple things. One, the debt paydown is very substantial. I mean, 3.1% 30-year fixed rate debt. Month one, you're paying $843 towards your principal. That is essentially a forced savings. At the end of year one, you will have paid off over $10,000 in your principal balance. At the end of year two, it's another $10,500 because it increases over time. Let's take a look at what your loan balance will look like after 5 or even 10 years. So that was year two, year three, year 4, year 5. So after 5 years of being in this loan, and remember your original loan balance started at $500,000, you will have paid the loan balance down to $445,000 after 5 years alone. That's about, let's see, what is that? $55,000 in debt pay down in only 5 years. Now let's take a look at 10 years. So if we jump over to, let's see, that would be 6, 7, 8, 9, 10. Okay, 10 years in, your loan balance would be $381,000. And remember the original starting balance of $500,000. So you've paid off about $120,000 in a 10-year period. So why is this so powerful? Well, I think a lot of people look at the pricing today and they're like, well, where is the price of homes going to go? Is it going to go up? Is it going to go down? Is the market going to crash? Because we know that prices are still sitting at all-time record highs. But what is not sitting at an all-time record high is the debt. The 30-year fixed rate debt is sitting at an all-time record low. And then we see inflation hitting all-time record highs. I think there's a better question that you can ask. That is the home affordable to you today given your current financial situation? And if the answer is yes, then what do you think this property will look like? Either the value of this property or the cost of goods and services or what your wages will look like in, let's say, 5 or 10 years. You want to be looking at this at maybe a 5 or 10 year time horizon so that you can weather any market turmoil that we may see here in the near term. So the main takeaway here that I wanted to leave you guys with is that 30-year fixed rate debt or mortgage debt, when used properly and responsibly, can actually be a tool to help you build your wealth, especially with interest rates being as low as they are today. Like I mentioned, month one, you're starting in this particular loan scenario, you are paying $843 to principal just month one. And if you extrapolate that over 5 or 10 years, the principal pay down gets even greater over time. It essentially snowballs. And after that 10-year time horizon, you've already paid down the balance about $120,000. Let's say the price of your home stays exactly the same over that time frame. You will have gained $120,000 in equity. But taking it a step further, if you believe that there will be more inflation, if you believe that your wages will increase, and you believe that the home is in a location that you want to stay long term, then odds are home values will continue to appreciate over the long run. Your wages will go up, which means that it will feel a lot easier to make that mortgage payment. And then the other aspect is consider where the prices of rents will go. Do you think rents will go up or go down in the future? I would place a bet based on the low level of inventory we have here in the California market today in Sacramento area. My guess is that rents are going to stay pretty sticky and likely increase over time. And if they do that, let's say rents rise on average 3% a year for the next 10 years, well then, or even 5 years, then this property that you are purchasing today, even if you are living in it today, it may make a very good rental over time. All right, so that's going to do it for today's video. Would love to know your thoughts in the comments section below. Do you think of 30-year fixed rate debt as an asset, or do you think of it as a liability? Do you think it's a good tool for helping you build wealth over the long haul, or do you think it could be something that holds you back? I'm just curious to know what you think there. Anyway, for more videos on finance, real estate, and investing, if you haven't done so already, please consider smashing that like button, hitting the subscribe button below, and we'll see you on the next video. Thanks for watching.